So, good afternoon to everyone, and welcome to the monthly Eurosif Sustainable Finance Update. As always, thank you for joining us today for what will be our last Sustainable Finance Update of 2022. So our next one will not be until the new year. We are yet to fix a date. In the meanwhile, though, we have plenty to keep us busy, as you will gather from this month's session. There's been a flurry of activity on the part of policymakers in the last few weeks as they work to finalize various work streams before the Christmas break. So there are plenty of developments to cover. With that said, we can move on to the next slide and take a quick look at our agenda for this afternoon. So today, we will start with an update on the ESMA draft guidelines on the use of ESG and sustainability related terms in fund names. Then we'll move on to the joint ESA's call for evidence on greenwashing before covering the most recent SFDR related developments, which include joint ESA's Q&As and the request by the ESAs for an extension of their mandate to revise the principal adverse impact framework under SFDR. We will then cover the final adoption of the Corporate Sustainability Reporting Directive, or the CSRD, and the delivery of the draft European Sustainability Reporting Standards, or ESRS. And then finally, we'll provide an update on the current state of play on the Corporate Sustainability Due Diligence Directive. On that last point, there have been developments right up to the last minute today, so we mightn't necessarily be able to cover everything in perfect detail, but we can give you a very good sense of what has occurred in the debate on CSRD up to now, at least. As always, throughout the update, feel free to pose any questions. We'll try and address as many of them as we can throughout the session, but if we can't, of course, we'll see if we have time at the end to respond. And of course, the slides will be made available on our website after the session today, and you'll be able to access them by following the link in the description of the video. A final bit of housekeeping is just to mention that in the new year, we'll be exploring how we can improve our SF updates, and in particular, we might explore changing the format, and if indeed that is our decision, we'll likely run a small survey. And if you regularly follow these updates, we would very much appreciate your feedback on some of our ideas for adjusting the way we do it. I think with all of that said, we can move on to our next slide and dive into the first agenda item. So on the 18th of November, ESMA opened a public consultation on proposed guidelines for the use of ESG and sustainability related terms in fund names. ESMA considers the manner in which funds are named as having a decisive influence over investors and retail investors in particular. And that influence is particularly important when, or particularly visible when names include ESG or sustainability related terms. So accordingly, ESMA's draft guidelines propose certain requirements that funds using ESG related terms in their names should adhere to. Important to note, ESMA derives its mandate to propose these guidelines from the AIFMD and the UCITS frameworks. in which there is an obligation for asset managers to act openly and honestly vis-a-vis investors. The draft guidelines in no way interfere, at least technically, with disclosure requirements under SFDR. But of course, as many of you are aware, the guidelines are likely to apply to many products classified in accordance with either Article 8 or Article 9 of the SFDR. And incidentally, part of the motivation for proposing these guidelines is in some way to compensate for the lack of any minimum criteria for qualifying for Article 8 or Article 9. So that is a bit of context for you. In terms of the actual proposals themselves, ESMA is proposing the introduction of quantitative thresholds for funds that include ESG or sustainability related terms in their names. So according to ESMA's proposals, in cases where ESG related terms are included in a fund name, 80% of the investments in the portfolio must meet or contribute to attaining the environmental or social characteristics that are suggested or implied by the name of the fund. And to give you a sense of what might be captured under this umbrella of ESG related term, if it's a sort of responsible water fund, that would be captured by this requirement, just to give you a very simple example. Now, it's somewhat unclear as to what an investment has to do to meet or contribute to attaining the environmental or social characteristic of the fund. That's still quite ambiguous. And I suppose at a bare minimum, it would mean that maybe sectoral exposures in your portfolio would have to be clearly relevant to the environmental or social objective or characteristic. Otherwise, in cases where the fund name includes the term sustainable, 80% of the investments in the portfolio must meet or contribute to attaining the environmental or social characteristic, and 50% of the assets must qualify as sustainable investments as per Article 217. So in the case of a product or a fund with both an ESG related, well, a sustainability related term, or using the word sustainable in the name, there's the two thresholds would apply: 80% investments meeting the environmental or social characteristic and 50% qualifying as sustainable investments. Perhaps, you know, more, well, very significantly at least, and we can move on to the next slide for this part. ESMA also envisages exclusion criteria to apply across the entire portfolio. And these exclusion criteria would align with those introduced for EU Paris aligned benchmarks. So if you look at the slide, I've listed them. I realize it's maybe quite a lot of text to see on a slide, but if you want to revisit it, it will be available. And probably best to just have, for ease of reference, all of these exclusion criteria in one place. But they include, of course, companies involved in any activities related to controversial weapons, companies involved in the cultivation and production of tobacco, companies that are in violation of the UN Global Compact and or OECD guidelines on multinational enterprises, companies that derive more than 1% of their revenues from exploration, mining, extraction, distribution, or refining of hard coal or lignite, companies that derive more than 10% of their revenues from the exploration, extraction, distribution, and refining of oil fuels, companies that derive more than 50% of their revenues from the exploration, extraction, manufacturing, or distribution of gaseous fuels. And then finally, companies that derive more than 50% of their revenues from electricity generation. with a greenhouse gas emission intensity of more than 100 grams of CO2 emitted per kilowatt hour. So this is actually quite a significant list of exclusions. They are largely meant to ensure that investor expectations with respect to ESG or sustainable investment funds are not confounded. So it excludes, you could say, the possibility of surprise holdings, as the UK's Financial Conduct Authority would describe them. And surprise holdings would be exposures that are inconsistent with the name or objectives of the fund. But just to give you some insight into maybe the extent of the exclusions, one of the most sustainable energy utility companies is the Danish utility company Ørsted. They would not be eligible for inclusion in a sustainable investment fund because of the exclusion on companies deriving more than 1% revenue from coal. It's a very small threshold, but even Ørsted, the greenest of the green when it comes to utility companies, would not satisfy that requirement. So that maybe gives you a sense of just how substantive these guidelines are in terms of the implications they will have for funds using ESG and sustainability related terms. Otherwise, it's important to note that ESMA, of course, states that these guidelines are not necessarily related to SFDR disclosure requirements, or at least don't interfere with them. But of course, many of you will be aware that funds adhering to these guidelines will nearly always be Article 8 or 9. That said, not all funds making disclosures under Article 8 will have to apply the guidelines, provided they have no ESG or sustainability related terms in their names. So as I mentioned at the outset, ESMA is consulting on these draft guidelines, and the consultation will be open until the 20th of February, 2023. And ESMA then will aim to finalize the guidelines with a view to publishing them by Q2 or Q3 of 2023. So that effectively concludes the update on these ESMA draft guidelines. And we've received just a number of questions, which I will try to address here now before moving on to the next update. But effectively, someone is asking, whether the ESAs have a mandate from SFDR to produce guidelines on marketing claims. And I would need to, I'm slightly, confused by the question that it seems that made perhaps in Article 13 of SFDR, but I frankly don't necessarily recall an explicit mandate. But of course, I think any proposed guidelines on the part of ESMA would be in the spirit of SFDR. But as mentioned earlier, in its draft guidelines, ESMA is very clear that it's not deriving a mandate for these guidelines from SFDR. It's deriving its mandate from AIFMD and UCITS, which of course, stipulate that asset managers, when dealing with clients, must act openly and honestly in a fair and non-misleading manner when it comes to any marketing communications. So again, this is why ESMA stresses that obviously, despite the relevance of these guidelines for products classified under SFDR, technically speaking, these guidelines don't stem from SFDR. So that's not where the legal basis is found. And I hope that clarifies the question or answers your question. But with that, we can move on to the next slide. And of course, On the 15th of November, the European supervisory authorities, or the ESAs, issued a joint call for evidence on greenwashing. And as part of this call for evidence is part of their effort to better identify and define the phenomenon of greenwashing. And just by way of background, in May of this year, the ESAs received a request for input from the European Commission in relation to greenwashing. And the Commission requested that the ESAs carefully monitor the market in sustainable investment products and the sustainable investment chain with a view to identifying instances of greenwashing. So, as in my view is evidenced by this call for evidence, the ESAs have been working quite extensively to develop their concept of greenwashing. And they are asking for feedback from the market. So this call for evidence will be open until the 10th of January, 2023. Now, it's already the 1st of December. And given the time of year and the fact that the period during which the call for evidence is interrupted by the Christmas break, at least Eurosif is going to be asking the ESAs to extend the deadline because I think it's warranted, and given the importance of the subject of greenwashing and how tight the deadline is, it's fair to ask for an extension, and hopefully the ESAs will grant it. But moving on to the next slide, we can explore a bit sort of conceptually how the ESAs understand greenwashing. And the ESA's concept of greenwashing is very broad, I would say, at this point. And they've identified a number of core features of greenwashing. And these core features include, say, sustainability-related claims that are misleading, exaggerated, outright false, or omit important information. Greenwashing can be triggered by claims in relation to or made by an entity or product. So it's not merely product level, it can also be entity level. Greenwashing can be intentional or unintentional. It can occur at various stages along a product life cycle or at different points in the sustainable investment chain. Greenwashing may arise in the context of regulatory disclosures mandated by EU legislation, such as SFDR, or it can be perpetrated by entities not subject to EU regulation at this juncture. And most notably, the ESAs point to ESG ratings providers. So interestingly, the ESAs establish three categories into which entities implicated in greenwashing can be placed when it comes to any particular instance. So entities can be what the ESAs describe as the trigger of greenwashing, the spreader, or the receiver. And I suppose the trigger could also be described as the perpetrator, if the greenwashing was intentional, and the receiver could be described as the victim, if you want to use that term. Now, somewhat encouragingly, the ESAs acknowledge that financial market participants may often be in the spreader category, as opposed to the trigger category. And financial institutions, they recognize, are to a great extent dependent on the reliability of corporate ESG disclosures to make their investment decisions and comply with their own disclosure obligations. And if corporate ESG disclosures are misleading, then of course it would be the corporate entity, the issuer, the investee company that is acting as the trigger of the greenwashing. The FMP would be categorized as the spreader if it was exposed in some way to that corporate entity. And the clients of the FMP would be the receiver or the ultimate victim of the greenwashing. Now, personally, I have to say, I find the ESA's approach to be quite quite reasonable. I mean, intellectually, I have to say that the way they describe greenwashing is quite comprehensive. That said, I think an argument could be made for regarding FMPs, not merely as a spreader. Of course, they can be a trigger in their own right, but very often, to me, in order for them to be a spreader, they have to first be a receiver. So this distinction between spreader and receiver might be a little bit artificial from my standpoint. In addition to that, it has to be said that not differentiating between intentional or unintentional greenwashing. I mean, I perfectly accept that greenwashing can arise unintentionally and often will, but there's a certain stigma that goes along with this term greenwashing. And if you apply it to an organization, to me, it suggests that they have deliberately or intentionally misled others. And, the ESAs, of course, recognize that in many cases, greenwashing will be unintentional. And so I think maybe another term needs to be developed to cover unintentional greenwashing. I don't necessarily see in media people making much of a distinction between intentional or unintentional greenwashing, and there'll still be enormous weight behind applying the term to an organization, and there could be severe reputational damage. So I do think there has to be more of a distinction made between intentional and unintentional. Otherwise, of course, very importantly, and something that Eurosif will be looking at in providing input to this call for evidence, is the fact that the ESAs ask whether the sustainable finance framework itself creates any risks for greenwashing, or whether in some way, or how greenwashing risks might arise in the context of disclosures at present and issues with the reliability of ESG data. So that, of course, is very important. Just as a reminder before we move on, of course, the ESAs have until May of next year to deliver an interim report on instances of greenwashing, the extent of greenwashing to the European Commission. And then, of course, based on that interim report, they'll do further work with a view to publishing a final report on greenwashing in 2024. So that brings an end to our update on the call for evidence. I'm conscious of time, so I might move on quickly to the next update and then pass on to my colleague Federica. And any further questions, of course, we can try and cover at the end if there's time. But I just wanted to briefly mention the joint ESAs Q&As on technical aspects of SFDR application, and the ESA's letter to the European Commission requesting an extension to the deadline for delivering their proposals to revise the PAI framework under SFDR. So first and foremost, the joint ESAs published Q&As on technical aspects of SFDR application on the 17th of November. Sort of my only real reason for wanting to cover this today is these joint ESAs Q&As are not to be confused with the queries the ESAs sent to the European Commission in September on SFDR. The Commission is yet to respond to those queries. And once it responds, the document containing both the ESA's queries from September and the Commission's answers will be described as a Commission Q&A. And that will provide substantive interpretations of SFDR's level 1 text. These ESAs Q&As are far less substantive, and it is confusing that we use Q&As to describe documents from different regulators, but that is unfortunately the case. These Q&As merely provide a practical clarification or instruction as to how FMPs should apply certain disclosure requirements in very much a technical way. So while it's useful for compliance departments, the Q&As don't contain all that much of note. Two things they do mention, which are interesting, however. the Q&As clarify that tracking a broad market index does not allow a fund to qualify under Article 9.3. They also state that FMPs are permitted to establish their own criteria for qualifying sustainable investments as per Article 217. And the only real reason I think that's worth remarking on is that, to my knowledge, in no other official document from EU regulators is it acknowledged that FMPs should develop their own means of qualifying sustainable investments. Of course, that's what everyone has had to do, and that's what everyone has been assuming up to now. It's just interesting to see it explicitly recognized, albeit, quite discreetly in a relatively innocuous Q&A document. Otherwise, the ESAs sent a letter to the European Commission to request an additional 6 months to develop their proposals for a revised PAI framework under SFDR. For background, very briefly, the ESAs received a mandate to revise the PAI framework in April of this year, and they were given 12 months to develop proposals to extend the list of mandatory PAI indicators and refine existing indicators. So I understand that the ESAs are developing rather ambitious proposals. They intend to consult on them in March of 2023, although that date might be subject to change. And accordingly, they require time to finalize their work. So they've requested this 6-month extension, and that should mean that their proposals should be due following a public consultation in October 2023, approximately. So that more or less covers SFDR and fund-related issues. I think I've been probably speaking for long enough now, and I will pass you over to my colleague Federica for an update on CSRD, the ESRSs, and CSDD. So Federica, please go ahead.
Thank you, Hugo, and very busy times for ESAs and for us. I will close this final edition for this year of the Sustainable Finance Update with some updates regarding the CSRD and the CSDD, so the two directives that will have a lot of consequences for financial institutions. So let's start with the CSRD. So in November, there were two major and final, I would say, developments regarding the EU Sustainability Reporting Directive. We left the file before the summer when the Council and the European Parliament reached agreement on the text of the directive after a series of trilogue negotiations. So what happened now? On the 10th of November, the final text of the directive was adopted by the European Parliament in plenary session and in large majority. After that, some days ago, on the 28th of November, the directive received final approval by the Council of the European Union. So following the Council approval, the legislative act was adopted. So what happens now in terms of process? So after being signed by the President of the EU Parliament and the Presidents of the Council, the directive will be published in the official journal of the European Union and will enter into force 20 days after that. The new rules will need to be implemented by member states, because we're talking about the directive, 18 months later. So in terms of contents, just a brief recap, the directive will require companies to report information on the risk and impacts related to sustainability matters and ranging across the whole spectrum of sustainability, so on climate, environmental and social topics, and on governance. And in particular, the directive will improve the current reporting framework that was introduced back in 2014 with the non-financial reporting directive. So introducing more detailed reporting requirements and enlarging the scope of the companies that will have to report according to these rules. So very quickly, the first reports are due in 2025 for large public interest companies with more than 500 employees, which are the companies that are already subject to the NFRD. And so they will report on data based on financial year 2024. So we will see report in 2025 referring to data collected in 2024. In 2026, large companies with more than 250 employees and or 40 million turnover and or 20 million turnover in total assets that are not now subject to the non-financial reporting directive will have to report data on financial year 2025. Then it's the turn of the SMEs. So in 2027, we will see the report prepared by listed SMEs, excluding micro enterprises, on their data regarding 2026 financial year. And I remind you that there is an opt-out option until 2028. So SMEs could decide to opt out of these requirements until 2028. Finally, in 2029, we will see the report of non-EU companies with net turnover about 150 million euros if they have at least one subsidiary or branch in the EU exceeding certain thresholds in terms of dimensions. And so they will report their information based on the financial year 2028. So, but about what companies are required to report? So which are the information required? And this question provides us a good segue to the following big update of the month, which is the delivery of the draft European Sustainability Reporting Standards by EFRAG to the European Commission. And with that, we can move to the next slide. So it's been a while since we last spoke about this, so let's take a step back very quickly. So the CSRD, so the directive, envisages the adoption of a reporting framework based on EU Sustainability Reporting Standards, or ESRS. The European Financial Reporting Advisory Group, or EFRAG, has been tasked with providing technical advice to the European Commission on the development of these standards. So basically, since June 2021, so well before the final adoption of the final text of the CSRD, EFRAG has been drafting a first set of standards which were published and subject to public consultation between April and August 2022. So now the update. On the 23rd of November, so last week, EFRAG delivered to the EU Commission the first set of sector-agnostic draft standards after considering the results of the consultation and the final text of the CSRD, which now we have, as explained in the first part of this update. So when we talk about sector-agnostic standards, we mean that companies operating in all sectors will have to report according to these rules. These are not specific for certain sectors or certain activities. This can apply to all companies. So this batch of draft standards includes 2 cross-cutting standards on general requirement and general disclosures. So these are principles and requirements that need to be followed across the all report, notwithstanding the topic on which the company is reporting. Then we have 10 topical standards covering climate, environmental and social issues, and governance. So in total, we have 12 standards. In addition to this, there are some interesting appendixes that are worth taking a look, especially for those of you that work in financial services. And in particular, I recommend Appendix 3rd, which contains a list of the data points in the standards that are in accordance, let's say, with other European Union laws. For instance, if you are looking for data points that constitute PAIs according to the SFDR, you will find here usual coordinates to find them. And then you will have Appendixes 4 and 5, which provide reconciliation tables between the European standards, the TCFD recommendation, and the ISSB general and climate standards. So it can be useful to navigate all these international standards that are now under development and understand what are the common parts and how to, find correspondences between reports compiled according to one or to the other reporting standard. So in terms of next steps, so what happens now with the first set of standards? The European Commission will consider the EFRAG proposed standards and consult with relevant EU authorities and bodies, including, for instance, the European supervisory authorities, member states, the European Central Bank. And a call for feedback would be open in March. And the standards are expected to be adopted by June 2023 in the form of a delegated act, which is, of course, subject to the scrutiny by the European Parliament and the Council as required by the normal legislative process. What is supposed to EFRAG now? So in the next months, EFRAG will focus on a second set of ESRSs or standards, which will include sector-specific standards. And in particular, EFRAG has already disclosed the sectors on which he's working on. You can have here a list reported in the slide, and they will also develop standards specific for SMEs. The second set is due by November next year, and the EU Commission is expected to adopt it by June 2024 with a delegated act. So now very quickly, if we move to the next slide, what changes compared to the exposure drafts that we saw and we commented on last summer? Very briefly. So first of all, we see that the overall structure and the contents of the requirements were streamlined. For instance, many disclosure requirements were merged and the wording was simplified. The distribution of the requirements across the two cross-cutting standards and the topical standards, and the distribution of the reporting requirements across the main body of the standards and the application requirement, which is another part, is clearer. So in general, it is easier to navigate the framework. More importantly, I would also say improvements were made to increase the interoperability of the structure and the alignment of key concepts with international standards, such as the TCFD recommendation, the ISSB standards, the GRI standards, and the guidelines of the OECD and the UN regarding due diligence. In particular, it's interesting to know that all the standards, all the EFRAG standards, so cross-cutting and also like the topical standards, are now based on a structure which mirrors the TCFD areas. So governance, strategy, risk management, including, of course, impacts with respect to the EFRAG standards, which are based on double materiality, and finally, metrics and targets. So there was this huge effort by the EFRAG to kind of update and review the overall structure. Another important development is the fact that the concept of rebuttable presumption was abandoned and replaced by a system centered on the materiality assessment by the reporting companies. So what does it mean? In the initial proposal, all reporting requirements were considered material. So if a company, after conducting a materiality assessment, decided not to report an information because deemed as not material, the company should have explained the reason for this choice. The result would have been a significant burden on companies and also like more longer and more complex reports. So in the current shape that is proposed now, companies conduct and describe their materiality assessment, and that will suffice, which means they did not have to explain why a certain information was considered as not material. So the framework is based on the fact that if a company describes the materiality assessment, that would allow users to understand why a certain information was not reported. Nevertheless, and importantly, certain disclosures are considered as always material and therefore must always be reported. And in particular, we are talking about reporting requirements included in the climate change topical standard, as information on climate are absolutely necessary, and data points corresponding to like EU law, data points required by the EU law, like for instance, data on taxonomy alignment, data regarding the SFDR compliance measures, etc. Finally, several disclosure requirements have been phased in, deleted, or reconsidered for sector-specific standards, including certain climate change-related metrics, for instance, the quantitative locked-in emission in transition plans or avoided greenhouse gas emissions. Of course, this is to strike a balance between the needs of users and the need of preparers, so the companies, which will have to improve significantly their reporting practices, and this will require time. So finally, I have just 3 minutes, and I will provide you with a very, very quick update on what happened this month regarding the CSRD, so the directive on the sustainability due diligence. So as we know, this directive introduces an obligation on companies to identify, prevent, bring to an end or mitigate the impact of their activities on human rights and environment. So both the European Parliament and the Council of the European Union are working on the file to reach a final, internal agreement. So in the Parliament, the committee responsible is the Committee on Legal Affairs, so the URI. On the 17th of November, we've seen published the report by the URI rapporteur, Lara Wolters, and MEPs had until the end of last month to table amendments to the initial proposal published by the European Commission. Yesterday, for instance, we saw 198 amendments tabled by the EPP, which is a political party, in the committee. So one of the most outstanding points, we don't have time now to go into the details, but one of the most outstanding points is the inclusion or not in the scope of companies operating in financial services or certain categories of financial services, and how these should be or not captured. And this is one topic that is absolutely relevant both in the EU Parliament discussion and in the discussion in the Council of the European Union. So with regards to the treatment of financial services, in the rapporteur's report, we see that there is a more progressive stance with the broadened the scope with regard to the definition also of the value chain with regard to financial undertakings. Whereas we have an opposite position in the EPP's amendments, because here financial undertaking are exempted. So it will be very interesting to monitor and follow the developments of the debate in the following months there. And as of next steps, the final position, so the final vote on the URI position should be scheduled in March 2023. But as you said, as you imagine, and there will be huge discussions, not only about financial services. So very quickly, what happened in the Council of the EU? I think it is important because there is a kind of today's update. So today there was a Competitiveness Council on Internal Market and Industry, and member states reached a general approach, which is a common position, a general common position on the text of the CSRD. We received the news just late this morning, so unfortunately we did not have the time to conduct a very detailed and granular analysis about this, but I'm sure that in January we will come back to you with more substance regarding this. But just to finish on the treatment of financial services, from what we've read from a very initial reading of the agreement, the compromise text leaves out of the scope financial products, which means alternative investment funds and UCITS. The basis for this position is the fact that UCITS and alternative investment funds are already captured in sector-specific legislation, which are the UCITS and IFE legislation. And also, as we read literally before dialing into this update, member states were provided with an option not to apply the CSRD to pension institutions that are considered to be social security schemes under applicable EU law. So we will further assess, of course, the details and the implications for the financial undertakings in the next few weeks, and I'm sure that there will be further very interesting developments regarding this file. I will now give back the floor to my colleague Hugo for the final closing remarks.
Thank you, Federica. So very, very comprehensive. So, I mean, that more or less concludes our update for today. I see we have one final question in the chat in relation to reporting under CSRD for non-EU companies. So I would invite Federica to see whether she knows the answer. I think I know the answer, but I want to make sure. If an EU subsidiary exceeds the 150 million euro revenue threshold, does it have to do the sustainability report for the whole group or only EU operations? Maybe Federica, I'll hand over to you first, rather than potentially say something wrong.
Thank you, Hugo. So we did not necessarily focus on this particular point. However, but my understanding may have some flaws. So please, Hugo, correct me if I'm wrong, and also like listeners can do that. From my understanding, the non-EU companies which are included in the scope of the directive will have to report only on the EU operations, but there might be flaws in what I am saying, but this is my answer.
And actually that's also was my understanding, that the sustainability reporting will only relate to the EU subsidiary itself and not the group as a whole. Provided, of course, the 150 million euro revenue limit is exceeded. So I hope that answers your question. And with that, I think we can conclude today's session, again, the last of 2022. So I will happily say I look forward to seeing you back in 2023. Of course, in the meantime, it might be quite early to say it, but I wish you a very nice Christmas break and a very happy New Year, and all of the best in the next few weeks before the holiday arrives. Many thanks, and have a good afternoon.